Hey everybody, happy Wednesday. As you may know, the Fed raised the rates today by 0.75%, and there's a lot of confusion over what that means in our world. Does that mean that mortgage rates are going to jump up 0.75% tomorrow? And the answer is no, probably no. The two things are not totally tied together. They're loosely tied together, but not totally. I'm going to show you a couple slides to illustrate that and give you some talking points that you can use when talking to your buyers and sellers and clients out there. So first of all, here's a slide that shows in the red, the Fed funds rate, and in the blue, the 30-year mortgage rate. You can see they track a little bit, but not totally. In fact, if you look in, 2006 through 2008, when the Fed rate bumped way up, mortgage rates moved a little, but did not follow the Fed rate. What the mortgage rates follow is the 10-year Treasury bill. This is a little hard to see, but you can see in the blue, there is still that Fed rate that we were looking at a minute ago. In the red, the bottom line is the 10-year Treasury, and this is what mortgage rates track. You can see the two lines above it, the yellow and the green. Those are 30-year and 15-year mortgages, and you can see they mimic almost identically what that T-bill does, 10-year Treasury, T-bill. It's called a couple different things, but that's what it is. And they go hand in hand throughout time. There's hardly any deviation from each other. So as opposed to that blue line that you can still see there, which is the Fed rate, which is what they raised today. That Fed rate, by the way, the things it's going to affect, and right out of the gate probably, credit card debt. That's tied very closely to the Fed rate. Car loans, tied very closely to the Fed rate. Student loans, a lot of them are on pause right now, but they are tied to the Fed rate. Home equity lines of credit. So here's where it might impact real estate. Those are tied to the Fed rate. Adjustable rate mortgages are tied to that as well. But your 30-year and your 15-year, those are going to mimic the 10-year T-bill, not today's news of the Fed rate. Now today, that's not to say today's news doesn't tie in a little bit. It is in there loosely, but it is not, by no means does today's 3/4 rate mean we're going to gain 3/4 of a rate in mortgages tomorrow or next month or even after. So one of the other questions that's coming up is a recession coming, likely. Now how deep it is, how long it lasts is unknown, but something about mortgage rates and recessions. Here's a graph that shows all of the recessions in the past, 20, 30 years, more than that, 50 years. And each time those mortgage rates fell during a recession. Now, actually, I should say that differently. During the course of the recession, the mortgage rates were a little volatile, but overall, from start to finish of the recession, mortgage rates fell. Here's another slide that shows that. The 1980 recession, 81, 82, the 90s, 2000s, the Great Recession, COVID. In every case, mortgage rates fell. It's one of the ways to bring us out of a recession, actually, is get the housing market going. So what's it mean? 30-year mortgage rates rely primarily on that 10-year Treasury yield, which is not the Fed rate, which is what they messed with today. And historically, whatever the 10-year Treasury rates were, mortgage rates are basically 180 basis points above that. However, recently they've been closer to 3% above that, which is odd. And that's being chalked up to uncertainty around a looming recession and also uncertainty around future rates. Like, are we pricing our rates too low if the T-bill keeps going up and we should be selling mortgages at 6% or 6.5%? So there's a little uncertainty there. And then when a recession happens, mortgage rates usually fall over the course of that recession. So that's all fairly good news, including something I didn't say, which is 5.25%, which is about where we are today in mortgage rates, is fantastic historically. So don't lose sight of that. What can a buyer do? They just need to stay flexible. They need to negotiate with sellers. That's happening now. We're getting concessions on price. We're getting concessions on inspections. Think about, do you want a concession? Do you want a buyer to buy down your rate a little? That is starting to happen specifically with new construction, but could be in resale as well. Shop for your loan. Make sure you're talking to the right people and get your finances in order, which these are, things that they should always be doing, but these are talking points you can use now to talk around the current rates. So a couple slides that I'll send out the cost of waiting to buy. So this is if interest rates and home prices rise. You know, if you go from 500,000 today at 5.5% to 545,000 next fall or next spring at 6%, you're going to spend 154,000 more over the life of that loan. So why would you wait? Another cost of waiting one just shows some buying power, purchasing power. If you had a $500,000 loan in this example at 5.25%, your principal and interest is $2,761. If you wait till it's at 6.25%, it's $3,079. That's a what, $318 difference. So quite a big difference if you wait. So there are some tools available to you that you can use to talk to your buyers and sellers, your buyers specifically, about the cost of waiting and things you can do. You can also go hear from the experts. Matthew Gardner put out a Mondays with Matthew this week that's pretty good, talking specifically about interest rates and the economy, so it's worth a listen. You can go find that on the Hub. And I think that's all I've got. So that's all I got. Just a quick hit for you on the Fed's rate rising today. It is not going to translate into mortgage rates rising 0.75%. There will be some volatility, and I've listened to Lawrence Yun from the National Association of Realtors this morning give his updated market outlook, and he's kind of expecting mortgage rates to sort of bump along between 5 and 5.5 all year long, and even into next year. Not going up a whole bunch, not going down a whole bunch, just kind of hanging out where we are. So at some point, buyers and sellers will get used to this new normal and re-engage and start buying again. But one of your jobs is to understand things like the fact that the Fed interest rate does not translate to higher mortgage rates. That's the T-bill or the 10-year Treasury. So just keep that in your buzzwords or in your pocket for those conversations and go out there and enjoy the sun. Good to talk to you.